My name is Jay Chauhan. I'm a lawyer in 3 jurisdictions, which is England, India, and Canada, which in Canada is Ontario. And in this town of Richmond Hill, I practiced over 40 years. I'm also a deputy judge, and I'm now retired as a deputy judge after 24 years as a deputy judge. But today's topic is on the question of the shares to be issued in a corporation. So I have with me Mariana, and Mariana is our resident expert on the corporate law. She does many corporations. We have almost 100 plus companies that we look after, and she looks after them. And so she'll frame the questions from the point of view of what typically needs to be done in a minute book when you're issuing the shares in a company. So I will let her frame the questions, and I'll answer the questions, and that'll be our session for today. So that's Mariana.
So today we have a client who believes that he needs to have new shares be issued. And my first question would be, how can new shares in a company be issued?
There are two ways in which the shares are issued, Mariana, as you've done it in this particular file as well. And one of them is you issue the shares from the treasury, which is the authorized capital. And historically, the authorized capital was limited, and you had to ask the ministry to limit and pay for the authorized capital, which people normally as accountants and lawyers call it the treasury. There are treasury shares from which you can issue the shares which are authorized to be issued directly from the corporation to the shareholder, or if there are shares that you have with the existing shareholders, you can transfer the required number of shares to the transferee, which is the purchaser of the shares. So that's the two basic ways of doing the shares, and each one has a different tax implication, but these are the two basic ways of issuing the shares in a company.
All right, so my next question will be, who can issue the shares? And additionally to this one is, can shareholders restrict the issue of the shares?
There are two sets of the people in a company. One is a shareholder, one is a director. And as you know, that it is the shareholders who elect the directors for 1 year at a time, and then the directors are the only persons authorized to do the share issuing or transferring, and not the shareholders. So therefore, the resolution you prepare in the minute book is that of the directors. Now, question is, can the directors use their own judgment and say that somebody's asked for the shares and make their own decision? They cannot actually. See, first of all, if there's a shareholders agreement, then this agreement of the shareholders actually binds the directors and shareholders in a smaller company. So the provisions of the agreement, if they are restrictive in terms of who can be the new shareholder, then that has to be observed. So in basic terms, the right to issue the shares, and when you prepare the minute book, the resolution you're preparing is that of the directors, but the other restrictions on who can issue and how they can be issued can be written in a shareholders agreement or other arrangement in the company that may exist. For example, in the articles, not more than 50 people can have the shares in a company. So a number of these restrictions have to be observed when you are issuing the shares. So that's first important to check it out, and then you prepare the resolution to issue the shares in a company.
Right, that's a very detailed answer actually. And what type of shares they can be issued?
Well, basically there are two types of shares: common shares and what used to be called preferred shares. They're now called special shares. And the main difference being that the preferred shares or the special shares have special designations. For example, the percentage of dividend that you can give. And these are written in the Articles of Amendment or the Articles of Incorporation. And if you do not have the specific types of shares that you want to issue, then as you did in this particular procedure, that you have to obtain Articles of Amendment to authorize the company to issue the shares which are with a specific amount of the dividend, 10%, 5%, whatever it is actually. It's just like a dividend. and you have to make a decision that these kinds of the dividends are cumulative or non-cumulative, etc. So these preferences and designations of the shares have to be specified, and the company has to be able to issue those shares because they're authorized to be issued from the articles or articles of amendment, and then you issue those special shares. Now, the common shares are those which are normally voting shares, and the main people in the company who own the company, they will normally own the common shares. And the special shares are issued to those people who are coming later in the company, have limited participation in the company, and they are not very often active in the company. But those instructions should come from the client and their accountant, and then we issue the shares in a company. But the common shares essentially are those where the final right of the dividend and voting belong. So those shareholders by a majority will make decisions as to the directors will be, and then those directors will act for 1 year's time to carry out the mandate of the corporation. So these are the two different types of shares.
Right. And what are the steps to issue the shares properly?
In a physical sense, here's the minute book, actually. So I think when you prepare the shares and you've got instructions, then we prepare a resolution of the directors, and you keep them specifically in the tab of the directors' resolutions. I think some of the new minute books I saw have one tab for resolutions in general, actually. And the reason for that is that now, in the Business Corporations Act, you can prepare a resolution, and if it is signed by all the directors or shareholders, and whoever is authorized to act in their capacity, like directors, if all of them sign the resolution, it's effective. So you prepare the resolution in the appropriate place in the minute book. You make the entry at the end in the shareholder's ledger, and if the shares are transferred from the existing shareholder to the new shareholder, then you write on the shareholder's ledger, as you can see here, that the shares are transferred from one shareholder to the next one. So the first step is the resolution of the directors in the right place in the minute book. Then you look at the tab that shows that the register for the shareholders is also amended and kept up to date. But in essence, what is effective is the resolution, which has the authorization from the business corporation's point of view to carry out the mandate of issuing and transferring the shares. And the record of the ledger is simply a record as a summary of the resolutions prepared. So when you have to send a notice, for example, of the annual general meeting, then that notice will be showing as to the address, etc., in the back of the minute book under the heading of the directors or shareholders ledger. So those are the physical ways in which the record is kept. And then, of course, at the end of the minute book, you see the share certificates. And when you purchase this minute books, you will see that they come in blank. And you write on the top the name of the person, in the second line, the number of shares that are issued, and then when the client comes back again into the office to sign, then it becomes a valid issued share certificate in the corporation. So then, of course, you send a report, and the book is normally kept in our office, and the report goes to the client with a photocopy of the share certificates, etc. In a bigger company, the share certificates may be held by the person himself. But in a smaller company, usually the share certificates are kept at the end of the minute book, inside the minute book, and kept in the lawyer's office. So these are the steps of issuing and the procedure in the minute book.
Right. And now let's speak about the officers of the company. Could you detail on the steps to elect directors, how shareholders elect directors?
The shareholders' right is, as you know, to elect the directors by majority. And the majority is 51%, unless there are some restrictions created in the company through shareholders' agreement. So from the business corporation's point of view, the majority, whoever that is the majority, will be in a meeting that is either called for that purpose or passed as a resolution signed by all the shareholders, will have the right to elect the directors by 51% majority. So just to clarify, this often becomes a problem when it comes to try to figure out what 51% represents. Now, it really does not make a difference if you have 100 shares, in which event you have 51% of the shareholders electing a director, or you may have 500 or 1,000 shares, in which event is 500 plus one, that will have the right to the election of the directors. So in smaller companies, for that reason, it's important that if you want to make sure that certain persons are the directors, and you do not want the majority to change the position of the director, then you have to make sure that the numbering or percentage works correctly. It's not the number that counts, but the majority that counts.
Right, and you mentioned rights of the shareholders. Could you give more details? What are the rights of shareholders?
There are two main rights of a shareholder. One of them is to vote in a meeting, and the other one is to obtain the dividend. So the function of the shareholders is to then say to the directors that.
Okay, now let's get to the shareholders. Could you give a little bit more information on the rights of the shareholders?
There are, Marina, two basic rights of the shareholder. One of them is to vote in a meeting of the shareholders to elect a director, and the second one is to get the dividends. And the way the dividends are organized, the accountant looks at the financial statement and sees how much profit has been made, and if it is warranted, then he would recommend to the directors, who would then say that that's the dividend they want to declare, which are the dividends that they will declare, and those are paid equally to all the shareholders for the same class. So that's how the rights of the shareholders are given in terms of what they receive at the end of the year.
Right, and what about their liabilities? What will be the liabilities of shareholders?
Well, the whole concept of the corporation is to limit the liability. That's why the reason for calling a company ABC Limited or Incorporated is to limit the liability of the shareholders who invest in the company. This is a concept that was created a few centuries ago in England, which continues in Ontario, and the whole idea of the liability was to limit the liability of the shareholders, so they invest the money in the company, and that investment made through the shares or a loan is the only amount that the shareholder is liable for. So the shareholder, if he didn't sign a guarantee, is not responsible for any payment of the debts of the company. But if he did sign a guarantee, which is very common for the landlord of the lease, then he becomes responsible. But from the point of view of the responsibility of the corporation or the shareholder, the corporation entering into a contract will become responsible for what the company does and not the shareholder. So there is a very fundamental important law that the shareholder is not liable, but the director takes the responsibility, and therefore he may be liable, for example, for filing the tax returns, but the shareholder is not. So that's basically the liability of the shareholder.
Right, and now let's get back a little bit to the beginning of our conversation. You mentioned there are two ways to issue shares. So could you speak about the difference between issuing the shares from Treasury and transferring the shares?
This is the transfer of shares after a company has been formed. What happens is the company begins to make a profit, it then pays its taxes, and the equity left in the company grows the value of the shares. And basically the value of the shares grows by the amount of the leftover equity in the company divided by the number of common shares. The equity and the value of the shares per share creates a cost base from the tax point of view. So when the shares are transferred to the purchaser and at a value that exceeds the original cost base, tax is payable. So if you transfer the shares from an existing shareholder to a new one, then you have to worry about the tax that they apply on the transfer. When you provide a share from the treasury or the authorized capital of the company, that question may not arise. But at the point of trying to figure out how to issue the shares, so give the new shares to a new person in a company, it is important to get the accountant involved in the company who would then decide the best way of doing it. But the fundamental difference being that the capital gains tax applies when you transfer the shares. So when you do it from one shareholder to the other one, it is very important to keep in mind that the event of the transfer, by recording it in the minute book, should not be done casually because the client says that I just want to transfer some shares, and he has not given a thought to the question of the capital gains tax. So you have to advise the client that it may attract the tax, to check with the accountant and get instructions from the client and the accountant to confirm that the mode of the giving of the shares from treasury or from an existing shareholder is done correctly.
Right, could you just give a little bit more information on how we involve the accountant, at what stage, like when it is the time to involve the accountant in the process of issuing the shares?
In my experience, the accountants very often are acting on their own, but in the case of a corporation, it is very important that they work like a team with a lawyer to try to work out the understanding of how the shares will be done. So if you're in estate planning, for example, or a regular new issue of shares, the accountant should be involved. And how do we get involved? So I think the best way is that you get instructions from a client and say, he will make a statement to this effect, or just issue so many shares to this person. That's all he says to you. So what you do at that time is to confirm these instructions and the implications of tax or otherwise of different issues that they have to think about. And then you get him to talk to the accountant, and then you ask the accountant, if possible, to confirm that he's in a position to give his opinion and confirm that the shares can be issued without any problems of tax or otherwise. And then you have a team working as a lawyer and the accountant to then advise the client. Then you carry on the transaction, as I said earlier, in the minute book, and you report to the client. And when the final report is prepared, I think it's even better and more cautious an approach to try to give the resolution as a draft resolution to the accountant and ask for his approval. So I think there's a much better practice to have the accountant involved at every stage of the decision making, as well as checking that the resolution you prepared is what he is advised to do. And then always confirming the reporting letter that the accountant's advice was taken and that is involved in terms of the decision as to the number of shares, in terms of the dividend, in terms of the tax implications, etc., and confirm that in the reporting letter as well. So he should be involved, in my view, right in the beginning and the end of the transaction.
Right. And one more question. I know sometimes our clients ask us to help them with tax planning. So could you dwell upon how can tax planning be done through issuing redeemable shares?
One of them, actually, it'd be difficult in this meeting, in a short meeting, to try to give all the different ways in which tax planning can be done by issuing the shares. But one method, for example, is estate freezing. If you want to transfer the value of the shares to the next generation in a large enough company where it is important to do that, then what you do is the existing shares are transferred from the owners of the common shares, and they are swapped, so to speak, with preferred shares that are redeemable. So therefore, redeemable shares can be redeemed anytime, even by the company, for a fixed value. And therefore, they do not grow in the value, whereas the common share will continue to grow in the value. And therefore, if you issue the common shares to the children at that time, when you start estate freeze and estate plan, then they benefit from the growth value of the shares without capital gains tax. That's the idea of an estate planning. So that's one example of what you can do in terms of the tax planning when issuing the shares. So when a client comes along and says, just transfer the shares, it is good to point out that it would be good to think out other issues that may be involved, such as estate planning, tax planning, etc. And this is one example only. So it's not an exhaustive list of things that he can do, but it is an important way in which you can advise the client to make him aware that the tax planning is possible at the time of the share transfer. So it's not the most important message, if I can convey that, is that when a client says, I just need some shares transferred, there are many other implications that we have to be looked at, and it's not just a paperwork entry that you pass a resolution and report to the client. It's not that simple at all. I think too many people make that mistake, and hopefully I was able to get the message across in this meeting.
Yeah, and my last question would be, sometimes clients come and barely say, we want new shares issued, right? And they don't understand all the implications of this step. So how do we get accurate instructions from the client?
Well, the best way is to get the client to write a letter. But I think there's, as I said to you earlier, that this may be a little bit more difficult for a regular client to say, okay, I want to issue the shares. So he says, well, what else do you want me to tell you? So the best way is that all these things that we discussed, tax implications, the advice from the accountant, what happens to the voting rights in the tax situation, and other tax planning situations, etc., should be written out in a form of a memorandum from our office, and we send it to the client and say, please sign in the form of instructions to us that this is what they want us to do. Those instructions written by the client and approved by the accountant then should be the instructions that we should follow through in the minute book, and then we send it back as a report to the client. And before, as I said, in a bigger transaction and a more serious transaction, we get the accountant to see the draft resolutions and we report back to the client. So these instructions are like a whole situation of client writing instructions, draft of the documents which the client approves, then the accountant approves, then they come in to sign the resolutions, and then we report. That should be the sequence of a typical manner in which we should get instructions. Not like a litigation situation where client signs a retainer. It's very different when it comes to corporate law, and that's why I wanted to make sure that you follow that approach in our office.
Absolutely. I think this is all the list of my questions for today, so thank you so much for such a detailed and educating meeting.
Thank you, Mariana, and I want to just say to you that this is a part of our mentorship program as well. Mariana works in the office, and for those who would like to join the mentorship group and those who are existing members, hopefully will watch this video, and if you'd like to be a member or have any comments, you can write to our email address j@jchaun.com, and for the mentorship, I think we have an address, mentorship@jchaun.com. I hope you enjoy the program.